Lim Say Boon, Chief Investment Officer with the Wealth Management Business of DBS Bank, joins us from Singapore. Mr. Boon, good morning and thank you for joining us. So when do you expect the hike in US interest rates, and what would be the implications of that on asset market? Because currently everyone is of the view that US interest rates in the system will not go up for at least a year or so.
Look, we do expect the first hike in the Fed funds target rate sometime in the second half of next year. Exactly when is a little bit hard to pinpoint, but if you look at where the Fed funds futures market is now, it's expecting the first 25 bips rate hike sometime in August of next year, July, August of next year. And if you look at the median forecast of the FOMC members, they are looking at the Fed funds target rate priced at about 1.13% by the end of next year, and well over 2% by the end of 2016. Nevertheless, I stress that I'm not sort of expecting the first rate hike to signal the end of the equities bull market. I think at 50 bips or even at 1% by the end of next year, the cost of money is still very, very cheap relative to the nominal growth of the U.S. economy. And if you look at the yield curve, the 10-year minus the 2-year U.S. Treasury yield, that still signals to us a very accommodative situation in the U.S., very supportive of the equities bull market. In very much the same way, if you look at the Fed funds target rate relative to the 10-year government bond yield, I think funds are still extremely cheap, and we can have significant rate rises over the course of next year and not have it necessarily terminate the equities bull market.
Lim, so where do you expect the yield curve to be at around the time or just before the time rate hike actually happens?
Quite clearly, as the U.S. economy continues to recover, we are likely to see some flattening of the yield curve. But we're still some point away from that complete flattening and inversion of that U.S. Treasury yield curve that would signal to us problems in terms of the ability of the U.S. economy to continue to grow. That's when monetary policy would be so restrictive that it could signal to us imminent recession and a bear market in the U.S. We're a long way from that.
So what is your reading of the Indian economy, and what is the level of interest among foreign investors?
Well, as I said, I think the market is going through a consolidation phase. The first stage was probably driven to a very large extent by domestic investors. I think the international market will gain more confidence when they start seeing supply-side reforms being delivered by the BJP. And that is absolutely crucial, because notwithstanding the sort of enthusiasm for the BJP, India continues to face the structural constraints of deficits in the government budget, balance deficit in the current account. These are supply-side issues. So the market will be watching very closely for the BJP to deliver, as I said. If they only deliver 1/3 of what they say they will deliver, that will be a huge plus. That will be viewed as a positive by the international investment community. That will drive the next leg of the equities market uptrend for India.
Lim, so what about demand-side pressures? The RBI has been trying to curb the demand-side inflation. What do you think should be the way forward for the central bank?
Well, you've got to strike a balance. At the end of the day, you've got to strike a balance, because you can't just simply stomp on demand entirely. The easiest way to solve your current account problem is to stomp on the demand and to drive your economy into a recession, but that's not a very helpful thing, right? So you do need to strike a balance between dampening demand and then unleashing the supply side.
Right. Lim, crude prices have been cooling off as supply fears in Iraq ease. What is your near to medium term view on commodity?
Well, Look, if only I knew how the conflict in Iraq is going to play out, and I don't. But at the end of the day, I still have to have a base scenario, a central scenario. Now, if the ISIS forces overrun the oil production facilities in the south, there is likely to be a very sharp spike in the price of oil. We could see the West Texas spike up towards $120 a barrel and maybe even beyond that. Simply because if there was a complete disruption to oil supply from Iraq, there won't be sufficient spare capacity within OPEC to offset that. You won't have a demand-supply imbalance which will drive crude oil prices significantly higher. That would be very negative for global economic growth and for the equities market. But our base case scenario is one of continued instability in Iraq, but the ISIS forces not succeeding in overrunning the oil production facilities in the south. Now, were that to be the case, crude oil could trade around $100 to $110 per barrel range for quite some time to come until we get more clarity on the ability of Baghdad to continue production and indeed to grow the production capacity in the south.